I'm ready for what's next. I'm ready for what's next. I'm ready cause some days and sometimes.
Hey everyone, Nick Fenton here, founder of TickerTank.com. 2 weeks ago I made parts 1 through 4 of the Iron Condor video series, and here we are 2 weeks later. I'm going to finish up with parts 5 through 7. I believe there will only be 7 parts, don't quote me on that, there may be 8. We'll see. But you know, I did a pretty solid recap of parts 1 through 3 at the beginning of part 4. And then in part 4 discussed the minimum probability of success, getting a visual of the break-evens on the actual price chart, and it just also kind of reviewed how to read this risk profile here on the chart. So 2 weeks ago, here's the exact trade that we were looking at. We were looking at this GDX December Iron Condor. The legs were the 21-23 call spread and the 18-16 put spread. So you can see here we're selling the 21 calls, buying the 23 calls, selling the 18 puts, and buying the 16 puts. So what you're doing there is you're combining a bull put spread with a bear call spread. So you know, 2 credit spreads combined create this Iron Condor, which looks like this plateau. You know, so all in all, we've talked about all the entry criteria that I kind of check off the list before I actually place the trade. So you know, that was kind of the last piece of the entry criteria puzzle in video 4. So you know, what do we talk about next? Well, when I go into a trade, I always like to know what my objectives are from a profit perspective. So you know, how do I determine my profit objective? Am I looking for max gain since this is a defined risk spread, or is there a point at which I consistently like to take profits? And the answer is B. There's a point at which I consistently like to take profits. So it varies case to case. Generally, I like to take profits at some point in between a 25 and 50% value decay, which seems, you know, is pretty standard for premium sellers to be kind of in that area. The way I determine where I'm going to be is simply based on, you know, how big is this entry credit. So we were looking at this GDX spread. The entry credit is 0.65, so 65 cents. So for every spread you're essentially selling to open, your max potential gain is going to be 65 bucks. Well, if you took 50% of 65, you're going to be roughly at 22 cents, let's call it. It'd be 22 and a half exactly, but you're not going to be able to fill at 22 and a half. So let's just say that you're looking for a 22-cent profit on this trade. That means that you're going to be trying to buy to cover at 23 cents. I'm sorry, did I say 22? 32. And you're going to be buying to cover at 33 cents. So your profit objective is 32 with the 50% value decay, and that means you'd be covering at 33 cents. Buy to cover at 33 cents. Is $32 a reasonable profit objective? In this case, I would say yes, but what you have to do is take into consideration what your commissions are, because everybody's commissions rates are a little bit different. So what are your commissions, and how do they add up in this particular scenario? With this being a 4-leg spread, it's a commission heavy strategy. So you definitely want to take commissions into consideration. You're going to have 4 legs on entry, and since you're doing a full spread exit, so you're exiting the entire spread after a 50% value decay, you're going to have 4 legs of exit commission. So that's 8 legs round trip. And depending on your commissions, that can be, you know, that can add up pretty quickly. But let's just say you have no transaction fees and $1 per contract to keep things simple as your commissions. That means you're going to have $4 in commissions per Iron Condor on entry and $4 in commissions per Iron Condor on exit. So that's $8 round trip per Iron Condor. So in this case, if we were to cover at a 50% value decay, meaning that we buy to cover at 33 cents for a $32 gross profit, if we net out commissions, we're going to net $8 out of that 32 bucks, which puts us at 26 bucks. So we're 26 bucks net of commissions. And I'm sorry, that's not right, 24 bucks. Been a long day. So $24 net of commissions. And is that a reasonable profit objective? It depends on you. I mean, what do you want to make out of the spread? For me, I think that would be okay. I would be okay with that. You might not find that reasonable, but I think it's reasonable. So it's just kind of a personal preference. Would I take any less than a 50% value decay? Probably not. Probably not in this case, because if we're sitting here looking at a scenario where our gross of commission profit is 32 and we net out the $8 in our simple example, and we're netting 24, then I don't want to get much lower than that $24 profit objective in a multi-leg spread like this when I'm risking 135 bucks. So essentially in that case you're risking 135 to make 24 net of commissions or 32 gross of commissions, however you want to look at it. I tend to look at things gross of commissions in most cases, but when you have such a commission heavy strategy like an Iron Condor that has 4 legs in, 4 legs out, I do tend to lean more towards paying more focus to the commissions exposure that I have in the strategy. So, what's happened since we started talking about this video, or since we did parts 1 through 4 when this spread was trading at 65 cents? Well, if we look at a chart of GDX, and let me just get this random line off of here. If we look at a chart of GDX, you can see it has been volatile, but we are pretty much in the same area as we were 2 weeks ago. So I guess we were probably around this area. And we're still kind of around that area. So, what has the spread done? If we unlock this price, it'll bring up and tell us what the current price of the spread is. So currently the spread's sitting here at 37 bucks. So this trade is a winner, pretty well right now. We're almost at that 30%, or I'm sorry, the 50% value decay price point, and it's possible that at some time during the holding period that 50% value decay has been achieved, and you could have filled if you had an order working to cover the position and automatically take your profits. Which brings me to my next point. On every trade I make, and I've talked about this in other videos, I'm going to put this back up to 65. So on every trade I make, I always put a exit position on. So what do I mean by that? Essentially, I go over here and let's just create duplicate order, and let's go down here, and what I do is I go to this advanced order area. Right now it says single order, and I go to first trigger sequence. So I change single order to first trigger sequence. Then I simply right click anywhere in this pink trade area. It might not be pink on yours, but I go over here to create opposite order, and that's going to create the buy side order here. And what I'll do is I'll determine, what is my profit objective. We discussed that already. If we're looking for a 50% value decay in this particular example, we'd be right around a $32 gain, meaning that we'd cover at around 33 cents. So I'll change my debit to 0.33, hit enter, and very, very important, I change this day order on the cover order here to GTC, good till canceled. So essentially what happens once I send this order, it just simplifies everything. I hit confirm and send, and what happens is it's going to route both orders. It's going to attach this bottom order that we just created, the opposite order, to this top order. So the bottom order is not going to start working until the top order fills. If the top order never fills by the end of the day, then the top order is it's just going to automatically get canceled. And since this bottom order is linked to that top order, it will by default be canceled as well. So there's no risk in doing this whatsoever. But if and when the top order does fill, you're going to automatically have this exit order start working for you, good till canceled. So if you're not at your desk, if you're in a meeting, if you're on the road, if you're at lunch, I mean, there's a multitude of things that you could be doing other than looking at your screen when this spread may hit that price point of 33 cents. And if you don't have this order working, you might miss that opportunity. So why wouldn't you have this order working is kind of my argument. So I always automate my profit taking. I don't automate taking losses. I prefer to self-manage that personally. But as far as profit taking, I'll automate it every time, 100% of the time. So what this does is it automates it for you, and it's really nice because some people prefer to enter the first order first, wait till it fills, and then create a closing order for that order after it fills. My argument is I've done that before, been there, done that, and I've forgotten many times. We're all human. I've forgotten that after that fills, I've forgotten to go in and put the closing order in, and I've missed opportunities. So why not just put it all in there right out of the gate and just make your life a lot easier? So, I would highly suggest doing that. Anyway, back to this, is there times when you're going to use less than 50% value decay as your profit objective? Yes, and that would just depend on your overall credit. So let's say we're dealing with a much higher price stock, and instead of having 2 points in between our strikes on the call side and put side like we have here, so we have a 2-point wide Iron Condor. Let's say we have a $200 stock and we have 10 points in between, and if we're doing 30% the width of the spread of 10, let's just say our credit ends up being $3, which is 30% of 10. Just to keep things simple. Now, don't pay attention to this risk profile. We're just kind of going off on a theoretical example here. So we've got a 10-point wide on a higher price stock. We've got a $3 credit, which meets our minimum 30% the width of the 10-point spread. And if you're to take 50% of 3, then you're going to be covering at $1.50 for a $1.50 gain, and that means a $150 gain per Iron Condor. When you net out your commissions of $8 in our theoretical example, then you're sitting at $142 net of commissions. That's a pretty hefty gain, and I would say that I'd personally be willing to take less than that. So maybe you only take 10%, and if you take 10%, then you're looking for a 30-cent value decay. You're going to be covering at, what would that be, $270. So you're going to be netting grossing $30, and the net of commissions you're at $22. If you deem that enough profit, then hey, that's enough profit. Take it. At the end of the day, the less value decay that you require, the higher the probability of you realizing profits on any given option spread that has to do with premium selling. So it doesn't always make sense to take a little percentage of value decay, as this example in GDX perfectly displays. I mean, if we tried to take a 10% value decay off 65 cents, we'd be looking at $6.50, per spread. Then we net out commissions, and we'd be at a loss. So that would make 0 cents. That'd be completely pointless. But like I said, the lower the value decay percentage you require, the higher the probability of you realizing profits. So if and when the opportunity to take less value decay than 50%, for example, I personally take it. So if I see an opportunity where a 30% value decay is enough profit for me, then I'm only going to require 30%. I'm not going to go for that full 50%. If I see an opportunity where 25 meets my profit objectives and makes, I'm perfectly cool with whatever profit the 25% value decay presents, then I'm going to go ahead and take 25% value decay. I'm not going to shoot for 50 every time, because the more times, the less you require, the more probability you have of realizing profits, and you can take that capital, put it into the next trade. That's my takeaway here. So that's all I want to talk about here in part 5, is just kind of the exit criteria that I go through. In the next couple videos, going to be discussing a few things, the difference between directionally skewed iron condors and unbalanced iron condors, as well as kind of touching a little bit on adjustments that you can make in iron condors. But that's a really broad, that's a really large topic. I don't think I'm going to be able to cover the entire multitude of adjustment possibilities, or when and how and why. But I at least want to have a little bit of a discussion about it, and people can ask questions in the comments after that. But for now, this is part 5 signing off. See you in part 6. Take care. Thanks for watching. Hope you're enjoying so far.